Welcome to the Market Cuddle, episode 5. I'm Gary, and I'm joined by
Philip.
So welcome to this investing podcast. Today's podcast, we're going to try and focus on lump sum investing, or like what we class as drip feed investing, just how to put your money to work into some sort of investment vehicle. In a previous episode, if you've not listened to that one, we were talking about different types of investing vehicles, which we will perhaps just recap quickly on that. So yeah, I think, Philip, do you want to just talk about those investing vehicles that we talked about last time in terms of the funds?
Yeah.
We're not talking about what we class as platforms, which is how you buy the funds.
Yeah.
Which I think is the subject perhaps of another episode where we'll look at those, and I think that might be quite fun. So yeah, do you want to just take us through those different types of funds quickly?
Yeah. So when you got the first ones, if you look at the big ones, you can buy individual shares of individual companies, so often referred to as equities, shares, or securities. The other things you can invest in are bonds, whether they're corporate or governments. But often, if you want to be diversified, unless you've got an awful lot of money, you can't really do that. So what you tend to buy is one of the collective investment schemes, which then allows you to have a little bit of lots of companies or lots of bonds to make you diversified. Now they break down into two main types, those that are called open-ended and those that are called closed-ended investment schemes. The open-ended investment schemes, terms you'll probably hear are unit trusts in the UK or open-ended investment companies, OEICs. These are more common names within the European Union, but they're effectively the same thing. These are where you invest in a small trust company who then buys the underlying shares into it. So every pound that you give them, they then go and invest. Every pound you pull out, they have to sell something to give you back the money. Other ones that are like open-ended investment schemes are exchange-traded funds, ETFs. They're very similar, but there you buy, instead of paying your money directly to this investment scheme company, you actually pay the money, you buy and sell them off the stock exchange. But once they've given the money, they then go and buy more shares, and when you sell the share on the stock exchange, they then go and sell the underlying assets to give you back the money. The other ones, which are closed-end investment vehicles, are quite different. These are companies in their own right, listed on the stock market. So you have an initial public offering where you gain the money from the investors. They will then go and invest that money. But unlike open-ended investment companies, when you want to get your money out, you just sell your shares in that company to anyone else on the stock market. The fund manager hasn't got to go and sell parts of the companies invested on your behalf to give you back the money. So there's no forced sales in a panic or anything like that. So things that are very liquid, this type of closed-end investment vehicle can be much, much safer. So there's no panic buying, or where you have very liquid items such as the Woodford funds have recently experienced. Now, the names for those type is investment trusts, which are very, very famous and very, very old in the UK, and these were founded in the late Victorian period, the 1870s, 1880s. And the other ones are venture capital trusts or private equity trusts.
Okay, so that's great. And as I say, if you want to go into more detail around that, I'd encourage you to look at the previous episode on those. It was interesting, actually, Philip. I got a question this week about how I think there was an impression from somebody who I was talking to that investment trusts are illiquid, i.e. you can't get your money out. And I'd said to them, that actually, as you said, no, you do, just like any company that you would buy, shares you would buy in a company, you can swap those around as easily as investment trusts, and actually, therefore, they're quite liquid.
And the problem comes with this name, and I found it when I first started investing years ago. Investment trusts and unit trusts sound very similar, but yet they're totally different. An investment trust, as a stock market listed vehicle company in its own right, when you decide you want to sell it, you're selling the share of that part of that investment to somebody else. So sometimes you can sell it at a profit or a loss to the actual underlying asset values of the things they've invested in. Whereas a unit trust, it just goes into a pooled investment fund where they go and buy more of that company, and when you sell it, they've got to sell some of it to give it back to you. So it's not a. So when they say close-ended, what they mean is the amount invested is fixed, and when they mean open-ended, it means it can expand or contract depending on whether people want to take their money in or out. But it's unfortunate because of the historic names we've used that people get confused.
Well, that's right. I think the investment trusts, in my experience, they're actually more liquid or easier to buy and sell and quicker in that sense than some of the bond funds where you have to wait for that deal to go off and be negotiated, and you might be waiting 24 hours, whereas actually with investment trusts you can probably sell that day and the money will be in your account that day to reinvest, maybe not to extract but certainly to reinvest.
And we'll go into another episode, we'll go into more detail because there's fundamental differences of how they trade, and we can go through the full risks and opportunities and when some are better than others at another date, because that's a whole podcast on its own.
Okay, great. So that's one to look forward to, I expect. Talking about investing then, so we've picked an investment vehicle or a company that we want to buy. Assuming I've got, a salary coming in, I've got a little bit each month that I want to put into a platform where I can go and buy shares. What's the best way of using that money in that scenario, do you think?
Okay, so just to put it in perspective, put some figures on what small means, and this is mainly to help explain what you can and can't do, or what's cost effective to invest in. So if we're looking at, we were saying small, we're talking at something around about a couple of pounds, a couple of £100, say £500 per month. That's small. When you're in that sort of size, it's not really cost effective to go and buy individual shares because of the trading costs eat up a lot of the fund value there. So that means individual shares, ETFs, exchange traded funds, and investment trusts or any other closed investment vehicle which are share based are just too expensive to buy. So realistically, you're pretty much only open to unit trusts and OEICs, open-ended investment companies. And the best way is doing that. You can buy lump sums of them, depending on who your provider is. It's maybe £50 to £100 a go as a lump sum, or you can do it per month and you set up a direct debit and do it every month, where you might be able to get to somewhere between the minimum amount being £10 to £25 a month. But over time, that allows you to get going. You're buying a diversified pool of investments. But unfortunately, at that size, that's your only option realistically.
Okay, so I think what you're saying is we could accumulate that monthly amount and then buy what we want to buy. So we could wait, be patient, and buy in bigger lumps, I guess, albeit we can invest every month a smaller amount. So what about, let's say we've got a slightly bigger amount of money, we might have inherited it, just come across this slightly bigger amount of money, we didn't know we had it, it was trapped under something heavy or whatever. So what are the better options then with that?
Okay, say you've got a sum of money, say £3,000-4,000 in size. There are a few more options now. Because you're in that sort of several thousands of pounds worth of value, shares or investment schemes that are by shares are now cost effective. So you could buy an individual share and make it cost effective, but that's only one share, so it's not very diversified. But you could buy exchange traded funds, ETFs, and the trading costs for those are now probably reasonably cost effective. Investment trusts now also coming in. The trading costs for them are now probably quite reasonable. Or you could still also go and buy unit trusts and OECIs. Okay,
so that's your kind of slightly larger amount of money. Let's assume I come into a big lump of money. What's the best thing to do with that?
So just to put it in context, when we're saying big lump of money, we're saying £10,000 or much, much more. This point here, you can buy individual shares, particularly if it's a lot more than £10,000, and be reasonably diversified at a reasonable cost. You can be your own fund manager and do it yourself. You can buy any of the sort of investment opportunities, where it's investment trusts, exchange traded funds, unit trusts, any of those, and they'll be reasonably competitive against each other. So you've got lots and lots. Basically, everything now is cost effective for you to buy in that sort of size.
Okay, great. So sounds like, just in summary then, if I've got a small amount, I want to drip feed, let's call it, a small amount into a platform to invest in something. It doesn't have to be a lot of money, be a little bit every month. You can accumulate it and just buy what you want to buy. Got a slightly larger amount of money, I can just probably then focus on shares rather than funds, let's say, in terms of ETFs. And then with a bigger amount of money, again, I can buy companies or investment trusts because I'm at the right scale. Is that a fair summary? Your face is telling me it's not.
No. So let me summarise. If you only have a small amount of money to invest as lump sum or regularly, you're pretty much left with unit trusts and open-ended investment vehicles, OECIs, as your only really cost-effective source. When you've got a bit more money, a couple of £1,000s worth, you can buy collective investment vehicles in funds which are share-based, such as ETFs or investment trusts, and they'll be cost effective. You could buy an individual company via its shares and be cost effective, but then you're very undiversified because it's only one company. When you get to much, much bigger sums of money, tens of thousands of pounds plus, you can buy anything and they'll all be cost effective. You can even start buying individual shares and start being reasonably diverse because you're buying several different companies. But the other thing that's worth mentioning then, once you've done that, is you also want to maximise your tax allowances each year that you use. In the UK, you've got your ISA allowance, which stands for individual savings account. So where once it's inside there, you don't have to pay any tax, UK tax on capital or income or dividends generated from it.
Okay, and that's tax on the way in and the way out? You don't get taxed for putting it in there?
With an ISA, the income you're using to go into it has been taxed for income purposes because of what you've earned elsewhere. But when the investment inside, any dividends that the investment inside it generates is tax-free, and any capital gains it generates inside is tax-free to UK taxes.
Yeah, it's worth saying neither of us are tax accountants, but it's worth making that point because I think for ISAs are quite a tax-efficient vehicle for investing, and given the fact fact that probably the money we're putting it in has already been taxed because we've earned it, let's say, unless we've been given it, but it's more likely we've earned it. So we've already been taxed on the way in, essentially. But the platform itself, putting that money in there, you're not going to get charged. And getting it out in the future
is then tax-free.
At the moment, at least, is tax-free.
Yes.
Which is kind of a nice...
The Chancellor may decide to change the rules at the next budget, which is always his prerogative, but as we stand today, he hasn't. So it's tax-free and the way out. So the important thing there is, even if you only have a small amount of money to invest, or as a lump sum, or a small amount of money to invest every month, it's probably best to utilise that in an ISA, tax allowance, to use that up. So even if you're only buying unit trusts because you can only afford to invest £50 a month and buying unit trusts, that's still a very good way for long-term savings. That's how I started out when I started back in 2007. For many years, I just bought unit trusts every month with an ISA account, which allowed me to build up quite a large sum of money that then made it cost effective to go buy other things.
Yeah, so it's the same adage of saving, like you would in a bank account, but you can use the platform where you buy your shares to do the same thing and accumulate it, essentially, ready to buy what you want to buy. So I think that's a good approach. And I guess where the individual savings account, the ISA you talked about, there's quite a reasonable size allowance on that each year, which most people are not going to meet that maximum. So all of your, as we said, on the small side, if you are saving every month into that account, you're not going to hit your limits anyway, are you? You're not going to have. That's not going to cause anybody a problem unless they are putting away
a lot,
the larger sums of money, which we.
And to put it into context, in this current financial year, tax year, the amount you can put into a stocks and shares ISA and a cash ISA together is £20,000.
Okay,
and it's quite challenging to put that in every year.
So yeah, on the UK's average salary, therefore, you're not going to probably be saving that kind of money.
No, and I struggle to utilise that every year, but if you don't use it, you lose it, and that year you can't re-put in more in the future because you didn't put it in last year.
Yeah, absolutely. So it's probably worth saying then that on the smaller side, if you're accumulating, the other option you've got outside of company pensions is a self-invested pension plan, which works fairly similarly to an ISA in terms of you can drip feed monthly amounts into that.
It is a pension plan, so the only difference between a SIP, a self-invested pension plan, is the things you can put in it. Unless you're basically, because you're running it by law, you could invest a lot of things into that. Not all providers give that opportunities, and these are different compared to personal pensions where you have very limited choices. With a SIP, you can invest in any listed share, any listed investment trust, any regulated unit trust, home and abroad. You could technically put commercial property into it. It's expensive to do that. You can other securities, bonds, almost everything. In fact, you can probably put more types of investment into it than you can into an ISA.
Okay. So we just say we'd encourage people, if they're looking to put some money away, is to have a look at what they've got in terms of pension already, whether through their employer or if they're self-employed or what have you, they do that themselves. Or don't forget, you've got this ISA allowance, which essentially is a good way of, I guess the best way of describing that is to tax wrapper your money so that nobody comes and taxes it again as you're investing it.
So if we take another option, so we take the one where maybe you have got a large sum of money you can invest. So say we're saying something of the order of, say, 10k of that sort of size, quite a large lump of money.
Yeah.
If we think about what sort of options do you actually have? Do you want to basically invest it all in one go?
Well, if you've got it, you might as well, right?
Well, you can do that, but if you think about, like we talked about before, what's the risks of doing that? Now, some people get quite concerned the fact that, have I actually invested at the bottom of the market? What happens if it goes down a bit further? They feel anxious about that. So some of the things you can do, instead of doing it in one lump, you could break it down into maybe 4 smaller lumps and do it once a quarter of the year, every 3 months. Or you could break it down into 12 pieces and do it once a month. And effectively, a bit like you do it, it's a bigger chunk of your monthly investments. And what happens there is every day the market decides whether it's a bit higher or a bit lower than it was before. And so therefore, but you're putting in the same amount each month. And effectively, some months you buy more of the investment and other months you buy less of the investment. So over that period you're investing in it, it's averaged out. So it's often called dollar cost averaging or cost pound averaging in the UK.
Okay, so you're averaging it into the market, and as you say, if the market's down on a day, actually that's good when you're buying in, and if it's up another month or another time you buy, so be it. But you overall, whether those, let's say you do it every month, you've got the average of 12 months price. So if it's averaging up, generally you've not paid the top price and you've not paid the bottom price all the time. Okay, so what you're saying there, I guess, is whether you've got a little bit of money going in or a large sum of money, you could do that style with both.
Yes.
It just means if you've got time and patience to do so. So does that then impact on, because you said earlier on there's charges and things related to different funds, how does that affect your fees?
Right, and this is where, so we say the open-ended investment schemes such as unit trusts and OECIs, they charge as a percentage of what you're putting in. So therefore, that's why it makes it them as a very small, very cost-effective, because it's your management charges and your transaction charge is going to be a 1%, shall we say. Whereas the other things, when you're buying shares, you have the actual transaction cost to buy the shares. Now, just taking an example of some of the mid-range stockbrokers, online stockbrokers such as Hargreaves Lansdown, Charles Stanley Direct, there you're charging, say, something around about £10-11 per trade. They're not the cheapest, but they're not the most expensive. They're sort of average at those sort of costs. So that's a fixed cost. So if you're buying £10,000 worth of shares, dividing your cost of £10 is divided over that. So therefore you've got your £10, your cost, against the £10,000 of what you're buying. But if you're only buying £100, that £10 is now a very large percentage of what you're actually trying to buy. So it's just not cost effective.
Yeah, that's yeah.
Whereas if you're...
Even I could do that maths. That's a lot of money to trade.
And that's where it comes from. When you're buying things that are when you're actually buying and selling share types, such as investment trusts, exchange traded funds, venture capital trusts, or individual companies, there's sort of minimum size you want to trade where the trading costs don't become prohibitive. Trading costs to the broker is only one of the costs. You pay the £10 when you buy it, and you pay it £10 when you sell it. There's another one when you buy it in the UK, if you're buying UK shares, is called stamp duty, also known as a Tobin tax, which is a transaction tax. So 0.5% of that transaction you pay in tax. So you pay £100, your transaction tax of the stamp duty will be 0.5 of that, which will be 50p. If you do 100,000, it's a lot of money, but it's scaled, so you pay that regardless of percentage fee.
Okay, so that's regardless of the provider you go for platform, you're going to be paying that tax because it's within the UK. But that just suggests then that you've got to take into consideration when you see a share you want to, let's assume we're going to buy a share that's costing you £1. It looks like the price of the share is £1. By the time you've added in the stamp duty and the cost to trade that on the way in and on the way out, or the buying and selling of that share is not going to cost you £1 to buy, is it?
No.
It's going to be more than that. So that's something to bear in mind, I guess. Just there are not hidden costs, additional costs that are going to be more than what, if you're looking at a share price on Google or wherever you're looking,
you pay more
to that. So the share's got to go up in value for you to get out for a profit.
That's right.
Which probably sounds obvious, but because you've got the costs on top of it. So have you got an example then? We've been talking about the different sizes of money. Have you got examples of how that cost influences those sums of money?
Yes. What I've got here as an example is we're going to buy a share, and we're going to buy £100 worth of share in one example, and the other example we're going to buy £5,000 of that company. So in both cases, we're going to go through a stockbroker. The stockbroking fee is going to be £10 for the trade. Now, what you have to know is you pay your stockbroking fee when you buy and when you sell. But stamp duty, which is 0.5% of the transaction, the trade, is only paid when you buy, not when you sell. In the UK, other countries, you buy and sell. It gets charged when you buy and when you sell. So with a £100 trade example, so we have a share which is £1 per share, or 100 pennies per share, which we're going to quote it in this way, and we're going to buy 100 of. That gives us a £100 trade. We have our stamp duty, which is 0.5% of our trade, so that is 50p in this case, and we have our stockbroking fee, which is £10, which brings the total to £110 and 50p, and when we divide that by 100, that gives us our price per share just to buy, which is 110.5 pence per share. So you've lost immediately 10% just to buy at that size. Now when we come to sell, we've got another £10 stockbroking fee, which we have to add on to that £110 and 50p, which then brings it up to £120 and 50p. So we have to make £120 and 50p to break even on £100 originally. So we divide that by 100, and that will then give us 120.5 pence per share. So as you can see, when you see these numbers, the shares have to make a return of 20.5% just to break even when you're buying and selling at such a small volume. And the reason there is your fixed cost, which is your stockbroking fee, dominates. It just dominates all your costs. Now we move to the next example. We're going to buy £5,000 worth of the same shares. So now they're still £1, so they're still 100 pennies a share, but this time I'm buying 5,000 of them, so I've just paid £5,000. My stockbroking fee is still £10 because it's per trade. Stamp duty this time, which is 0.5% of my £5,000, is £25. So my total costs to buy the shares is the £10 stockbroking fee plus the £25 stamp duty, that's £35. So it's cost me £5,035, which, when I divide it by 5,000, gives me 100.7 pence per share. So effectively, I need to make 0.7% just to break even from just buying it. Now, when I come to sell it, I still have to pay my £10 stockbroking fee, but there's no stamp duty to pay because I'm selling it. So our total trading cost selling is £10. So we add the £10 to the £5,035, which brings us a grand total of 5,045. So when you divide that by 5,000 shares, you get 100.9 pence per share. So as you see, the share price has got to rise by just under 1 pence per share to break even, which is just under 1%, so it's 0.9%. The shares have to increase to break even. So as you can see, it's a big difference. Now, if I was to buy much bigger sums, eventually the sort of cost of transaction will even itself out to be the stamp duty. It'll be ever so fractionally higher than the stamp duty, because the fixed costs, which is stockbroking costs, get less and less important because it's driven more and more by this fixed 0.5%. So the bigger the trading volume you have, the lower and lower your transaction costs. And this is the thing where it comes to going fixed costs against variable costs. And this is one of the reasons why unit trusts, when you're small, is so good, because you've just got a fixed percentage cost to transact, not a fixed monetary cost. And that's why when you're buying shares or share type investment funds, such as unit trusts or ETFs, I would generally say you're in the several thousands of pounds as a minimum before your transaction costs become reasonable, so they're in the 1 to 2% territory. And that's just to give you a rough example of what it costs, because you can get slightly better stockbroking fees than £10 from certain stockbrokers I can think of. You can also do a lot worse than that, because I also know other stockbrokers that will charge you a lot more.
So no, I was going to say that's a good example, but it's actually a horrible example, because it shows you the massive shift in stock price that you need when you're trading at small numbers. You know, fundamentally, you're talking about, let's say a 1% shift in the £5,000 trade, which you might well see, in a day on the stock market, certainly within the week. Whereas a 20% change in the share price, you might be lucky to see that in a year.
If that happens in a day, it's generally the stock price is crashing because there's a profits warning. Generally, you don't see them move that much, even in a week.
No, I mean 20% is a large, a share that is a pound in value. To get it to £1.20, you'd be quite pleased with that increase over the course of a year.
Yeah.
Now, okay, for long-term investors, you could argue that's not a major problem. But again, you've waited a year to break even. Not to make a profit, but to break even. So that's... it is a good example to just perhaps remind people that when they are using a stockbroker or a platform to buy and sell these stocks or funds, that you need to be aware of the fees.
Yes, and this is one other one I found is when I was starting out, because I didn't have several thousands of pounds to buy and sell at any one time. It just was not worth even considering investment trusts, even though investment trusts have lots of good advantages for them. I just wasn't at a scale that it's even worth considering, or ETFs, and I just went straight for the unit trusts because at the size I was, the right cost-effective answer was that. And depending on where you are, depends on what is the most cost-effective solution for you. And it changes over time. It's not a fixed one. And by the time you actually save more, the options of what maybe is the best thing and what is the most cost-effective changes with you.
Yeah, and I suppose there's been quite a lot of talk. You talked about dollar cost averaging versus pound cost averaging, which is the same thing essentially. We just tend to hear more about dollar cost averaging because we tend to see a lot more investment information and advice coming from the US than we do from the UK. And in the US, there's been a lot of talk about the platforms out there are going fee free. When we say fee free, we're talking about the stockbroker fee that you talked about, not necessarily whatever's going on with their equivalent of stamp duty and their taxation, which is kind of beyond the scope of what we're thinking about. But for me, if you are going to drip feed, are we in a position at the moment? Are there any tricks or tunes you can play with lowering those fees?
Yes, there are. Now, this is something we'll cover in a future episode where we go more into details of different platforms, different providers and what they charge, because they all charge different amounts. But I do know certain stockbrokers that will charge preferential trading costs for reinvestments of dividends. I mean, like they'll charge you £2 if it's a dividend reinvestment. I know other stockbrokers that won't, and in fact, the minimum you're basically stuck with their minimum trade level. So that it all depends. But what you'll probably find are those stockbrokers that are making that special fee is mainly targeting certain types of investor that want to reinvest dividends, and they're happy to take a loss on that because there'll be other fees elsewhere. So it all depends on how you want to invest and what type of investor you are, whether that platform is actually the most cost effective for you, because there's those people who actually want to trade more actively and those that just want to be more passive and just buy and hold, and the different platform provider that is most cost effective for those types of investor are quite different. But that's quite a long episode, and that'll have to be for another day. But it's quite range. Some of them will drop the fees, some of them won't. Some of them mean that when you trade in unit trusts, it's fee free. Others, no, they charge a small fee even if you're changing from unit trusts, but it's a lot less than if it's a share.
Okay, so I think what we're saying is it's obviously a picture dependent on your individual circumstances, and and we're not financial advisors, so if people want help, they can get that. But I think it's worth, certainly from the examples that you've given, knowing if you're going to be investing, do that simple calculation and work out what you're going to be paying, because as you said, it sounds like there's various different providers out there and they will charge you different amounts. Being aware of that before you get into a situation where you've signed up for something that is probably costing you more than you would like it to, given your circumstances for investing. And that will work for your long-term investor. So we said about saving, accumulating that money, buying the shares or funds that you're happy to buy, and ideally keeping them for the long term. And ideally those in the long term will go up in value, hopefully. It all sounds a bit steady. And sometimes when you've got a small amount of money to invest, I hear people talking about CFDs, that, better off going and doing something in that area. Is it something you've come across or have an opinion on?
Well, by CFDs, I assume you're referring to contracts for differences. So,
and I'm assuming I am as well.
I know of them. I've never personally traded in them.
No, neither have I. Just
to give the audience a vague idea of what they are. This is effectively a private contract between two parties about where an indices or a stock or any sort of price of a security, where it is now and where you think it's going to be compared to where the market is on a set date. And then you pay, depending on where the price is relative to your position and the other party's position, one of you pays amount for every point, which is 100th% it is away from where you agreed it's going to be. So it can go up and down by quite a lot.
Okay.
So, but you're not owning the underlying security, it's a private bet or contract between two people. So it's more like betting.
Right. So that's quite different to share ownership that we've talked about. And I believe there's leverage involved in this, where you're not just putting your £100, let's say, your monthly saving amount up, you can then leverage that to make that a bigger number?
Yes, I believe many of the brokers who offer CFDs will offer leverage with that to quite high numbers. We're not talking just 1 or 2 times here, we're talking maybe 10 or plus times leverage on those. So that leverage can allow you to earn lots of money or lose lots of money really fast. It's not something I know a huge amount, although sometimes, for those who've ever seen The Big Short, there's a great description they gave about what a credit default swap is, and then what a synthetic credit default swap is. The fact that it's just a bet or a gamble between two other parties about the price of something else. Yeah, it's more akin to that in many people's eyes. But it's something that some people do use, some people do make money out of, but when you see a lot of the adverts that are for CFDs, I have to remind people that most people, often say 70-75% of the people that do this, lose money. So it's not something you want to go in blind. It is quite complicated. Some people can make money. It's not simple, but it is very easy to lose lots of money very quickly if you don't know what you're doing.
Okay, so there's opportunity to make money, but it sounds like you really need to do the research on that before you go anywhere near it. Certainly myself, as a mere mortal, would run fairly quick in the opposite direction, I think, with that kind of product, by the sounds of it.
And it's safe to say I don't feel confident I know enough about them that I've ever gone anywhere near them yet.
Okay, so, but it's an option for people if they feel they know enough about it to go and dip their toe in the water. But again, like we said with the other ways of investing, look at the fees, look at the leverage on that one specifically, and also just be aware of the risks before you go into that. Okay, so we've gone through kind of lump sum investing, drip feed investing, that pound cost averaging you talked about, and it's worth saying we don't promote anything on this podcast. We were just trying to give an honest opinion. So it just leaves me to say thank you to Philip, and we'll see you next time on The Market Colour.
This programme has been presented for information and educational purposes only. None of the information or content of the programme is to be taken as an offer, opinion or recommendation by the programme's hosts or guests to buy or sell securities. Nor is it intended to provide legal, tax, accounting, commercial or financial advice. Opinions and comments are based on information from sources believed to be reliable. All investing involves risk as prices go up or down based on a number of factors. Always consider consulting a financial professional before investing.